Okay, why don't we go ahead and get started? Everything good, Will? Will's giving me the thumbs up. All right, so we're trying to figure out how to turn the cameras on for our analysts, but we'll get there. But anyway, thank you guys for joining. So my name is Mark LaMonica. I am the product manager for Morningstar Premium and morningstar.com.au. Today we have two special guests, which is exciting because I was originally going to say you don't have to look at me the whole time, but now, of course, that we can't get the cameras on, that might be the case. But anyway, we have two of our analysts. I'll introduce them in a second, but first, our housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you. Johannes knows nothing about you. And Gareth knows nothing about you. So we can't offer personal advice. If you are in New Zealand, you can get our FAP off of our website, morningstar.com.au. And also the New Zealand regulatory authorities say that you should go see a financial advisor if you would like personal advice. So today, we are going to talk a little bit about two recent IPOs. So we'll talk about PEXA and Endeavour. So as you probably guessed it, Johannes and Gareth cover those companies for us. And this is the start of, we can call it Equity Week, because on Thursday, we are doing a webinar on how to value a share. So Johannes and Gareth, if you guys are free, it'd probably be beneficial for you guys to tune into that so I can teach you something. But yeah, we'll talk about equities this week. So maybe first we'll just do quick introductions, and I can describe what they look like. Maybe that would be exciting for everyone. But why don't we start with Johannes? Do you want to introduce yourself and tell us, just tell us sort of what your coverage universe is while Shani struggles to turn on your camera.
Hey, of course. Hi, Mark. Hi, everyone on the line. My name's Johannes. I cover the retailing sector at Morningstar, and that includes big names like Woolworths, Wesfarmers, Coles, and now the newly listed Endeavour Group as well. As stocks on the smaller end, you probably see Meyer run today. That's one of the smaller names we cover. So that's basically the space that I look at. I've been looking at retail for the last 5 years. And before that, in my previous life, I was a resources analyst looking at oil and gas and mining companies for 10 years, writing research on those.
Okay, awesome. And Gareth, you want to introduce yourself quickly?
Yeah, hi everyone. My name's Gareth James. I'm an equity strategist here at Morningstar. I've been analysing stocks for around 20 years, including around 10 years at Morningstar. My coverage list is kind of roughly referred to as technology companies, but that's quite a wide remit. So it can include things like REA Group, Domain, Technology One, ASX Limited, Computer Share. So there's quite a wide range of stocks on my list.
All right, awesome. Why don't we get started? So in the last couple weeks, we've had two new listings on the ASX, which we're going to talk about today. So maybe you guys can just give a brief overview of what each one of these companies does, and then we can talk about sort of where this IPO came about. And then we're going to go through, I think, what we'll go through today is we've talked a lot about what is a great investment. Well, a great investment is, of course, finding a great company and then purchasing at a compelling price. And we'll sort of follow that. Path as we learn about Endeavour and PEXA and what our view is of them. And then finally, of course, any questions you want to ask our analysts, you can ask them, and maybe we can run a competition where you can guess what they look like. And I don't know what the closest person would get, but maybe that'll be a fun way to do this. So why don't we start this time with you, Gareth? Oh, there he is. There's Gareth, right on cue.
Hello.
Okay, good news. Okay, well, Gareth, why don't we start with you? Tell us a little bit about PEXA, how this IPO came about, what the company does, and we'll use that as a starting off point.
Yeah, sure. So PEXA is in the conveyancing sector. So conveyancing is the exchange of ownership of real estate. So historically, the way that worked was that it was very paper-based and very labor-intensive. So people had to get in a room and exchange checks and legal documents and that kind of thing. And PEXA was created by a consortium of state governments and the big four banks in Australia and various other parties who participate in the real estate market in Australia. And the aim was to digitize the whole process, to effectively make a website where you can go on and use it to buy and sell real estate. So specifically the legal ownership exchange process. So that's what PEXA is. It undertakes what's known as e-conveyancing, so electronic conveyancing, which is pretty much the whole of the conveyancing market these days. There's about 20% which is still being done in the old way, but ultimately everything will be done via PEXA's platform. So that's a bit of background to PEXA.
All right, and then how about how this IPO come about? Because it is a little bit of a interesting ownership structure, which I know we'll touch on later, but maybe just sort of the backstory to this IPO.
Yeah, sure. So if you think that, PEXA was basically created by a consortium of governments and big four banks and stuff who needed to come together to, all agree on what this platform would look like and how it would work. Once that was built, most of those organizations didn't need to be involved with the business anymore. And so most of them sold out around 2018. And PEXA was going to be listed on the market at that point, but the technology sector had a bit of a mini crash at that stage. So it was instead sold to a group of companies, so to Commonwealth Bank, Morgan Stanley, and also a company called Link Administration. Now, Link is a company that's listed on the stock market. In the last couple of years, Link's share price has been very weak for a number of reasons, and there's been a lot of pressure to get the share price up. And one of the options to do that was to consider an IPO of PEXA to more clearly recognize the value of that asset. And ultimately, that's what's happened. So Link has remained as a shareholder in PEXA, which has just been listed, as has Commonwealth Bank. Morgan Stanley's sold out, and new investors have bought into the company to replace Morgan Stanley.
Okay, awesome, Gareth. So I think we'll turn it over to Johannes. Talk a little bit about something that's more in my wheelhouse, drinking and gambling, instead of home ownership. So do you want to give us a little bit of an overview of Endeavour?
Of course. Thanks, Mark. So in a nutshell, Endeavour is exactly what Mark just mentioned. It's a retailer of liquor, and it also owns hotels or pubs, if you like, that derive a large amount of their earnings from gambling, from electronic gambling machines. So Endeavour is probably not familiar to many of you, the name, but if I mention Dan Murphy's and BWS, that'll probably ring a bell, hopefully. And Endeavour owns both those brands and operates the stores. And you'll probably see a lot of Dan Murphy's and BWS's around Australia because Endeavour has around 50% market share. So every second bottle of liquor bought, so to speak, on the retail side in Australia goes through Endeavour on their retailing, on their liquor retailing segment. And that's the largest segment for the group. It accounts for about just over 2/3 of all earnings. And then the lesser part is as Mark just mentioned, also the gambling side of things, so the hotels. So it's not just EGMs or the pokies within those hotels, but also they also generate earnings from food and beverages, as well as accommodation in some instances. So that's a broad overview. They're basically Australia-wide, those stores. You'll find them in all states. And as I say, they're a dominant player, a 50% market share.
Okay, great. And let's talk about the IPO. So where did this company Endeavour come from?
Yeah, it's actually quite interesting. So Endeavour Group, until 2 weeks ago, was part of Woolworths Group. So our leader in supermarkets retailing. So what Woolworths decided around 2 years ago is to demerge its liquor and hotels business. And that got somewhat, I would say, put on hold during the whole coronavirus outbreak and pandemic, when there was just so much uncertainty in the markets, and restrictions and lockdowns meant that the hotel segment, nearly their earnings went down significantly, not to zero, but next to. So it was probably not the right time to list this vehicle a year ago. But now, given that there's a lot more certainty on the outlook, on the economic outlook, on how this pandemic's playing out, Woolworths went ahead with this demerger. The reason why I'm saying it's interesting is because if you look at Woolworths, who's the leader in supermarkets and the second largest supermarket chain in Australia, which is Coles, which is also listed, that they tend to copy each other's moves. They've done that on the petrol side of their businesses as a most recent example, but also going back. And this is just another one of those examples where we're basically falling down the same path as Coles. So Coles got rid of its gaming operations a couple of years ago, and Woolworths obviously doing it now with that demerger. And even though neither company will explicitly say that ESG or environmental, social, and government concerns risks play any role in the demerger, we suspect that that's been a strong driver or rationale for this demerger. So again, the demerger for Endeavour Group coming out of Woolworths, it's a very attractive business in our view. You probably wouldn't sell it or demerge it necessarily under any other circumstances. But given that there is some ESG risk attached to that business, and some investors might not want to own it, Woolworths went down that path just a few years after Coles did something very similar on the gaming side.
Cool, thank you. And yeah, nice timing, right? That they delayed this IPO till things settled down with COVID, and then did this 2 weeks ago. Seems like a good move, right? But that was a joke. You can laugh at it. Anyway, let's keep with you. So let's talk about moats a little bit. So both these companies have moats. So let's talk about Endeavour Group first. Why did you assign it a moat, Johannes?
Yeah, moats. And moats are rare at Morningstar in Australia. And wide moats are even rarer. So we have wide moats, narrow moats, and no moat companies. And the wide moat companies are quite rare in Australia. And what we mean by that is companies with a sustainable competitive advantage over decades in our minds. And next to Wesfarmers, which owns Bunnings, Endeavour is the only retailing company in Australia, or stock in Australia, that we cover with a wide moat. Now, why do we see Endeavour having it? It's really its market-leading position is the key. And what it means being about 3 times the size of Coles' liquor business. So that's the next largest competitor with centralized overhead costs and supply chains, is that Endeavour can fractionalize its costs over a much greater sales base. So each singular item will have less fixed overhead costs ascribed to it. And what we also see with Endeavour is, because of the strength of its brands, the Dan Murphy's and BWS brands, is that the sales productivity in its stores is much greater than Coles's, which together with its scale advantages really is reflected in much greater profitability. So any given dollar in sales on the Endeavour side is worth about 50% more than what it's worth to Coles. So that's the leverage, and that's the operating leverage that Endeavour enjoys through its scale. So basically, the large scale, the 50% market share of the group in liquor retailing, really underpins our wide moat that's sourced from cost advantages. So from the advantage to be able to have a lower cost base per sales unit.
Okay, right. And so that is the moat source.
Yeah.
So it's something we've talked about this before, that obviously, moats, which were popularized by Buffett, that we've quote unquote borrowed from him, talking about the sustainable competitive advantage. There are different sources of moats that we've identified. So in this case, that would be the moat source for Endeavour, so cost advantage. And that, of course, means, and we talked about this before in terms of moats, that you are able to earn a margin that is higher than your competitors, because that's not competed away as more and more people compete with you. So, of course, if you're able to do stuff cheaper, you can charge the same price, have a larger margin, or you can lower your prices and grow market share, right? So, yeah, that's our example for Endeavour.
And that's exactly what we're seeing here. And from the competitive standpoint, why we think this is sustainable is because it's really difficult to unseat a market leader such as Endeavour. The only really threat that we can see is from the online side. And we had a close look at what Amazon is doing in online. So they started selling liquor on its platform in Australia last year in June, about a year ago. But even with a really positive, optimistic outlook really on Amazon in Australia, on the liquor side of things, they won't reach 2% market share, not even within the next decade. So that means that there's very little threat there from Amazon disrupting Endeavour. Endeavour itself is already the leader in online retailing for liquor, so really no threat there. Aldi had been grabbing share quite a bit while they were still rolling out their stores aggressively, especially over the last 5 to 10 years. But that store rollout has now come to an end. We expect Aldi to grow their supermarkets at around the same pace as overall market growth. And because the liquor stores are within their supermarkets, around 2/3 of Aldi's supermarkets have a liquor store attached to them, that is joined at the hip, that rollout. And with the stores not growing faster than the market, the liquor side of things won't grow faster than the market, and Aldi will probably sit around 4% market share over the next decade in our mind as well. So again, the key threat really from online for many retailers. For Endeavour, though, it's not really a threat because Amazon is not a strong player in the liquor category to begin with, and Endeavour just leads online liquor retailing in Australia.
Okay, great, thanks. So, yeah, the first checkbox here in terms of a great company, we mean great companies do have sustainable competitive advantages. So, as Johanna said, that this is rather rare. So let's go over to you, Gareth, and talk a little bit about moat in terms of PEXA. So once again, it's rare, but we've got another moated company here.
Yeah, that's absolutely right. So at the moment, PEXA has two sources of its wide economic moat. So the main one at the moment, I'd say, is its network effect. So that is a situation where, people can't compete with a company because everybody uses a different company and they all interact via that company. So I'll give you an example, like Facebook, for example. It's very difficult to create a rival to Facebook because everybody uses Facebook and you want to communicate with lots of your friends who are all on Facebook as well. So it's kind of like a marketplace situation. So, the ASX Stock Exchange is another example. It's a marketplace, so it has a network effect. So that's the situation with PEXA. All of the banks, all of the conveyancing firms are all using PEXA. So if you want to do a real estate transaction in Australia electronically, you have to use the PEXA platform. Now, there is an attempt to break that network effect, which is coming from politicians and the regulators, right? So they don't really want PEXA to have a monopoly. So they've come up with this idea to try and undermine its network effect. And what's likely to happen is in a couple of years' time, other companies are going to be allowed to effectively plug into PEXA's platform. And that will mean that they don't need to have all of those participants on their platform in order to undertake a real estate transaction in Australia. But the issue that competitors are going to face is that there's very little incentive for the users of PEXA's platform to switch to an alternative platform. Because the way that we think about PEXA is it's a natural monopoly, right? There's not much point in having another version of PEXA because PEXA does the job that's required. So yeah, we think in the long term, switching costs, customer switching costs, are going to be the real barrier to competition in the e-conveyancing market.
Okay, awesome. So in this case, we do have two great companies in Morningstar speak because they both have wide moats. So let's focus on the other side. Of course, buying something at a compelling price. So we're going to spend some time on this on Thursday, but people that have attended before, we've talked a little bit about how a share is valued in our methodology here at Morningstar. So of course, Gareth and Johannes and the rest of our analysts are looking to the future. Anytime that you buy a company, you are buying that company because of what that company can generate from a cash flow perspective in the future. So obviously what they're doing is building models out into the future and estimating how they think this company is going to do. So why don't we start with valuation? Maybe we'll keep with you, Gareth. So maybe, what is the valuation that you have put on PEXA? And then what are some of the key inputs that go into this model that you're creating when you're trying to forecast out in the future?
Yeah, sure. So our fair value estimate for PEXA is $13.20 per share. So the stock, since it IPO'd a couple of days ago, it's trading pretty well and it's up around $18 a share. So we're valuing it much less than the market. Now, the key drivers to our valuation are the expected profits that the company is going to make in future. So I guess the first place to start is revenue, obviously. So the way that PEXA generates revenue is that it charges a fee every time somebody buys or sells a house in Australia. So the two key variables there are the number of houses that are sold in Australia and the price that PEXA charges to use its platform. So at the moment, PEXA charges about $70 to use its platform. So every house that gets sold, the buyers and the sellers have to pay about $70 to use the PEXA platform. And then, the number of houses that get sold in Australia is variable. Then on the cost side of the business, that's pretty stable. That's basically a group of people in an office. You've got a bunch of software engineers, you've got some admin people, accountants, that kind of thing. But those costs aren't particularly variable, largely fixed costs. So there's quite high operating leverage in this business. So, the big thing that's likely to move around is the number of properties that are getting sold each year. So that will cause variance in PEXA's profits. But yeah, because the company's got an economic moat, we expect it to generate pretty high profit margins relative to other businesses on the market. And yeah, that's basically the main drivers of earnings for PEXA.
Okay, awesome. Thank you. So same question to you, Johannes. What are you looking at for Endeavour in terms of valuation and the drivers behind that?
Yeah, of course. So before Endeavour listed, we published a fair value estimate of $6.10, and that's unchanged. And where the stock's been trading, it's been a bit volatile the first couple of weeks, obviously, but it seems to be settling around that price at the moment, which means right now, in our mind, shares are fairly priced. So they're not overvalued, they're not undervalued. They don't offer a significant margin of safety for investors buying here, but anybody holding this name should be rewarded with his or her cost of equity, which we estimate around 7.5%. So from the valuation grounds, there's nothing wrong with Endeavour at these price levels. It's not a screaming buy, as you might like to say, but it's fairly priced. What it does offer, though, to investors is obviously a fairly high dividend yield of around 4%, which is going to be fully franked on our estimates, and a dividend that's going to be highly sustainable. And the reason why we think that's sustainable, that comes to the second part of your question, Mark, is that given the industry in which Endeavour sits and its already large market size, we see fairly limited top line growth, so revenue growth optionality for Endeavour, at least organically, which means the top line is going to grow somewhere around the 3% mark over the next decade. Every year by about 3% over the next decade. Earnings are going to grow a bit ahead of that at around 5% each year on average, just because we can see the profitability of this business improving and benefiting and predominantly from greater efficiencies, but also beneficial profit mix as we see, or product mix if you like, as we see a greater shift to higher value private label offerings, so higher value for Endeavour. Generally, they're obviously cheaper price tags for the consumer, but thinking about margins and profits per bottle, it's higher on the private label side than any branded or national brand product that Endeavour would sell. So the outlook is nothing to write home about. It's low single digits on the top line, and on the bottom line, mid-single digit growth. But, and here's the big but, we see that liquor sales are highly predictable, just like food sales. So we view liquor as a consumer staple, something that consumers will buy throughout the cycle, throughout the economic cycle, whether or not things are going well or not so well, people consume liquor. And going back 30 odd years, it has always been the case, except in 1991 in that recession. But otherwise, even during the GFC, liquor sales were strong. That was 2008, 2009. And most recently, in the pandemic, liquor retailing was actually boosted by all the lockdowns. So they've had an incredible run since, especially in FY21 due to lockdowns. So again, in our mind, highly predictable earnings when we ascribe a low uncertainty to our forecasts, reflecting that's similar to what we use, or the similar uncertainty rating we use for Woolworths and Coles. And hence, because the earnings are very predictable, the dividends will be predictable too. And we expect a very high dividend payout ratio of around 80%. So Endeavour is fairly valued at current price levels, but offers an attractive dividend, which we see as sustainable and not very volatile going forward for investors.
Okay, awesome. Yeah, and liquor is certainly a staple in my house, and I've been trying to drink more than 3% more each week. So I will hopefully help sales, although a Vintage Cellars is the closest liquor store to my apartment. Obviously a competitor. But let's talk a little bit about what Johannes was talking about in terms of uncertainty. So uncertainty rating. So of course, what Gareth and Johannes and the rest of our analysts are trying to do is they're trying to forecast the future. The future is obviously unknowable. And so each one of our analysts puts an uncertainty rating on everything that they cover. So it's one of the ratings you get. You obviously are going to get the fair value. You're going to get the moat rating. You're going to get an uncertainty rating. What that uncertainty rating translates into the margin of safety that we think is appropriate for investors to go in based on our different star ratings. So as you described, staple doesn't generally move with business cycles in terms of liquor sales. What about PEXA? So obviously, Gareth, you talked about how housing sales are the key determinant in their revenue. What do you think? How does that fit into sort of our methodology for assigning an uncertainty rating?
Yeah, look, I think the appeal of PEXA is that its earnings are pretty stable. So obviously it's got a monopoly, a wide economic moat, but its earnings are very stable as well. So over the long term, the number of housing transactions in Australia has grown by about 4% per year historically. We think that's going to be slightly lower going forward. So we've got 3% per year growth. On a year-by-year basis, it can swing around a bit more than that. So, in 2020, there was, because of the lockdowns, lots of people pushed back the sale of their houses. They've come through in 2021, and we think that's one of the reasons why PEXA has been listed now, because its short-term earnings look very good. But over the long term, we expect a very gradual, steady increase in housing transactions and therefore revenue, and therefore earnings growth for PEXA. So yeah, we have a medium uncertainty rating for PEXA. We don't see much risk in the earnings forecasts relative to a company such as like a biotech company or a mining explorer, something like that, where there'd be a huge amount of uncertainty with regards to the range of potential earnings outcomes.
Okay, awesome. Thanks, Gareth. So we do have a lot of questions. Some of them are questions I was going to ask, so I think it's better to get some of those questions. And we have a good comment from Mim. So Mim says, "Good on you, Mark, for helping the economy with your liquor purchases." So thank you. Most people encourage me to drink less, but I appreciate you saying that. One last question before we get to all the questions we're getting from people watching this is for you, Gareth. So the ownership structure of PEXA. So you mentioned Link, of course. Link is, as I think you pointed out, another company that is within your coverage universe. So let's talk about the ownership structure that Link still has. And you talked about Link being undervalued compared to your fair value. So yeah, what is and I know you said this in the past, what is the best way to actually access exposure to PEXA in this market?
Yeah, sure. So we think that the better way to gain exposure to PEXA is by buying shares in Link Administration. So their ticker is LNK. So that's a company that we believe has a narrow economic moat, and we believe it's been undervalued for quite some time. And I think that's why we saw takeover bids for the company last year come in, which have kind of triggered this PEXA IPO. But Link owns more than just its 43% shareholding in PEXA. But we think that Link's other businesses are good also, and also a bit beaten down. They've had some negative news in the last couple of years or so, and we think that's going to start to improve. So, for example, Link provides administration services to superannuation funds, but mainly to the biggest industry superannuation funds, right? And there's been a lot of news about this in the last week or so, the new rules that have come into force. And I know I got an email recently to say, you can check the performance of your super fund versus all of the super funds now via the ATO. And there's no surprise that the best performers are the big industry super funds. So we think that those big industry super funds are going to keep winning market share. That's going to be a benefit for Link. That's another aspect of Link's business, but also we think that its investment in PEXA is great. But we think that the investment in PEXA is being undervalued. So it's a better way to access PEXA than buying PEXA shares directly, which we think are overvalued.
Okay, great. Thanks, Gareth. All right, so we're going to get to some questions. So we'll start off. The first question's for you, Johannes. So Julie says, what hotel brands does Endeavour own? And then I've got a follow-up question for you. So maybe Julie is in New South Wales dreaming of being able to go out to get a beer right now. But yeah, what hotel brands do they own?
They do own a minor brand in terms of where you have your overnight stays, but essentially you won't be able to see from the outside whether a pub or a hotel belongs to Endeavour. So it's not a chain as you might suspect. So it's not like a BWS or a Dan Murphy's, but it's basically your pub down at the corner might be part of the fleet, and Endeavour owns over 300 of these pubs nationwide. But as I say, they're not branded as of today. So perhaps that's a business idea for them, perhaps, who knows?
Nobody wants to go to a branded pub, right? That doesn't, well, I'll talk about your German heritage later. So another follow-up question from Paul. So he's talking about RDC. So RDC is also a pub owner. is that a competitor, a serious competitor for Endeavour? And Paul follows up and said, would Endeavour ever look at taking RDC out? So I assume not in a fight between management, but through a takeover. So yeah, any comment on that?
Yeah, absolutely. So yeah, I've spoke at length on the competitive dynamics on the liquor retailing side, but I've neglected the hotel side. And in hotels, Endeavour is also the market leader in Australia, although that market is much more fragmented. So you don't have the big players there. Endeavour has around 10% of the market share, and then Red Cape is obviously much smaller. Now, the way that the hotels business works is, you have a catchment, and then within that catchment sits a pub. So there might be in any catchment area that there might be instances where a Red Cape pub might be competing with an Endeavour pub, but we don't see them as competitors as like Coles or Endeavour would be on the liquor side. So it really depends on the catchment area if there's an overlap or not. Secondly, on the gaming side, so what I haven't mentioned is that on the gaming side, that EGM, so electronic gaming machines in Australia, the number of them hasn't really changed in the last few decades. So there are around 200,000 of those across Australia, and Endeavour has over 12,000 of these. Now, there are limits to how many gaming machines can be in a pub. There's limits by state how many gaming machines an operator can own. For instance, in Victoria, Endeavour has already reached that cap, so they couldn't operate more EGMs even if they wanted to under current state regulation. So, and these gaming machines, they have licenses attached to them, and obviously they can't be taken away. So that also speaks to the moat. So once an operator has these licenses, people flock to these gaming machines, and they'll be able to derive revenue from it. So thinking about competition, would more competition be driven to a pub owned by Endeavour versus Red Cape, were the Red Cape pub to close, or to get less capital allocated to it for refurbishment, say, to make it more appealing? Yes, perhaps in some catchments, but as I say, Red Cape is a much smaller player. In terms of takeovers, so I generally don't speculate on any M&A. Is it a possibility? Yes, it could be, but then again, price is always a consideration. So at what price would they be able to acquire it? Secondly, how would that fit into the whole strategy? And I saw that there's other questions there on, hey, how will Endeavour going forward manage their ESG risks? So whatever thinking that the management team has there for now, will they want to increase their exposure to gaming? Yes or no? That we'll just have to see, as it's just newly listed management team. It's just out there now, so we'll have to track it, and we'll get more of a vibe and more of a feel where they're heading with their strategy. But in having said that, the returns on capital are generally greater on the liquor side than on the hotel side. So that would also speak to more capital, more funds flowing into the liquor retailing side versus the hotel side. So I hope that answered your question.
Okay, awesome. Thank you very much. So Gareth, what do you think about this? We have Johannes on here, and he doesn't wait for me to ask questions. He looks them up himself and then answers them. So I don't know about that. Remember, I can turn your video off again. All right, so let's get in a couple PEXA questions now. So, Gareth, I know that you've written about this before. We've got a question from the anonymous attendee, who is our favorite attendee on here, who does not wish to be known, that wants to know about PEXA's overseas expansion into the UK. So they are allowed to go to the UK, but you are not, as a native of England. So you can share your personal feelings on that, or talk a little bit about PEXA and their potential expansion plans to the UK.
Yeah, look, the overseas expansion is interesting. I think the thing about PEXA is that they've certainly got a monopoly in the Australian market, and that's great. They've got a phenomenal business in Australia, but when you list a company on the stock market, when you undertake an IPO, what a lot of people want to see is what's exciting about the IPO. What's going to get people buying the shares that you're going to float, and so managers of IPOs tend to come up with all sorts of potential growth options when IPOs happen, and some of them are quite far-fetched. With PEXA, it's come up with three main growth options, right? It's talked about expanding internationally, it's talked about selling its data, and it's also talked about making investments in other companies via a venture capital business that it's created. Now, the venture capital business, we don't really think that that's got much legs, right? I mean, I think that's a bit of a long shot. Maybe they'll make some good investments, maybe they won't. The data should be good, but I think it's going to be small for PEXA in the grand scheme of things. The international opportunity is probably the most interesting opportunity. So PEXA are talking about going to the UK, where they still use a kind of an old paper-based system for conveyancing, and building a platform similar to what they've got in Australia. Now, there's a lot that PEXA would need to achieve to do that, and there's a lot of differences in the UK to the Australian market. So there's a long way to go. So far, PEXA have hired one person in the UK. So it's still very, very early days. They don't make any money over there. Now, in the IPO prospectus, PEXA estimated the value of the UK market. And I'm just having a look at my model, and I think they came up with a figure of $700 million, Australian dollars. They said that's what the market could be worth. To be honest, no one really knows, because we don't know what the UK market would look like longer term, what the structure would be, how much they would charge. So, we at Morningstar could look at that and we could just say, well, look, that's too much of a long shot. Who knows if it's going to work out or not? It may not. Therefore, we won't include any value into our valuation for the UK. But we actually think there is a chance that PEXA might achieve something in the UK, and they have created the first e-conveyancing platform in the world. So I think they've got a reasonable chance. So look, we've made some estimates about the market size, the probability of success, which we've given a very low probability of just 15% at this stage. And we're going to keep an eye on it, right? So depending on how PEXA progresses, we might increase that probability of success gradually, and that will increase the value that we attribute to the UK business into our PEXA valuation. But yeah, at this stage, it's a bit of a long shot, but it's not something that we'd rule out completely.
Okay, thank you. So we've got a couple more PEXA questions. I will say that if we were looking at overall questions, people are more interested in gambling and liquor than housing, which is amazing, because I didn't think Australians were interested in anything more than housing, but here we go. So two questions around sort of transaction fees. So Carrie wants to know, just to clarify, you said $70 per housing transaction. Is that $70 on each side of the transaction, so $140 total, or just 70?
Yeah, that's a good question. So the way that PEXA talks about a transaction is it's every time an individual uses their platform. So if you have the sale of a house, you'd have a buyer, you'd have a seller. So each of those parties would have to use the platform. So that would be, on average, $70 for each person. So you're right about that. But each person may also have other fees associated with that. So it could be $280, say. It's kind of difficult to know. It depends on the transaction. So for example, if you refinance your mortgage, from one bank to a different bank, you have to use the PEXA platform and you have to pay a fee. So in that case, it would probably be about $70. So the total fee that's charged varies depending on the situation. And then, the fees vary quite a bit. The $70 is like the average fee. So going forward, we expect there's going to be fewer mortgage refinancings, because we think that, we've probably got interest rates as low as they're going to go. So, if we're going to see interest rates rising going forward, that's going to be less people trying to refinance with different banks and get a cheaper mortgage. So mortgage refinancings cost less than when you sell a house on the PEXA platform. So yeah, that's a couple of comments about the fees.
Okay, and then there's just one more question about sort of the level of those fees. Now, obviously, you said that 70 is an average, and people are paying different amounts. But Eric was asking, is there any sort of regulatory requirement to keep that fee under a certain level, or would you expect perhaps that they could raise those overall average fees, especially since houses are obviously going up by so much? I don't know anyone who's buying a house in most places in Australia right now. They're going to notice that $70 being added on. So yeah, any chance to raise those fees?
Yeah, look, PEXA is highly regulated, and this is one of the reasons why we don't expect competition to come in. The fees are already very highly regulated. PEXA will only be able to increase their fees, around 2% a year. It's probably going to be linked to inflation going forward. And this is one of the reasons why the company needed to have some kind of exciting growth options to tag on to the IPO. But yeah, I mean, going forward, the fees are only going to increase by a couple of percent a year, maybe. The big driver of revenues, the big swing factor, is going to be the variation in the number of real estate sales. But look, there is an upside to that fee being regulated, which means it's pretty hard for another firm to come in and say, hey, our fees are a lot cheaper, because PEXA's fees are already capped, right? So they're limited to, they can't really price gouge in that way. Whereas if you look at a company like, say, REA Group, so realestate.com.au, if you want to put your house for sale on that platform, you have to charge, you can pay about $2,000 to advertise your house. So yeah, in relative to that, PEXA's fee is tiny. Most people don't even know that they pay it. Very often it's hidden amongst other bank fees. So when I refinanced my mortgage recently, it took me a number of phone calls and emails to get them to break out the PEXA fee to show me that it was there. So yeah, that's another reason why we just don't think people are going to switch to a different platform. It's a tiny fee. They're never going to notice it. And another platform with lower fees is not going to be very appealing.
Well, that's good that you're incorporating your research into refinancing your house.
Yeah.
We're probably the most annoying customer that bank has ever had.
Yeah.
But yeah, that's good. All right, so we're going back to Endeavour for a second now. So Mim, who supports my drinking, wants to know a little bit about the debt to equity ratio for Endeavour. So Mim is saying 175% per the ComSec site, and yeah, wants to know, is this going to be a problem, particularly if we're moving into a situation where interest rates are actually going up? So any thoughts on debt, Johannes? I know as a German, you are not into debt by nature, but tell us a little bit about Endeavour.
Yeah, we Germans don't like leverage that much, but
Greeks who take leverage.
The debt level there quoted by ComSec, and I can just read into that number, but the only way to get there from our end is if you include the operating leases and treat operating leases that are on the balance sheet today, as of 2 years ago, due to an accounting change, are included in debt. So when including operating leases in the total debt, so not just bank debt, but also operating leases, you can get to that figure. Now, the outstanding debt is much less. So at the end of the year, we estimate debt levels to be around 1.5 billion in off the top of my head. So that's a lot less than that CBA number suggests. So which again includes a lot of operating leases, which don't pay interest, right? So that's they won't change with interest rates going up and down. So the remaining interest-bearing debt is absolutely manageable at net debt to equity at around 30%. As we mentioned earlier, cash flows are highly predictable. the cash conversion, which means that the quality of the earnings, like how much of those earnings are actually cash and not due to some accounting shenanigans, so to speak, is very high. So and the, as I said, the company is well funded. So firstly, the debt levels aren't as high as that figure suggests. It's more around just over 30% net debt to net debt plus equity on our numbers, and they will easily and comfortably be able to meet their interest requirements, of that interest-bearing debt, even if and obviously that's not a given either, if interest rates should increase. And having said that, also obviously all that debt doesn't mature next year or the following year, but the debt maturity profile is spread out over a number of years, and with interest rates also partially locked in. So short answer, no, we're not concerned at all about rising interest rates on their ability to pay interest. However, and this is the second part of the answer, is where interest rates to rise, it'll have larger implications on equity valuations broadly, and including Endeavour. So how much return will shareholders or equity investors want from an investment in equities, and that is likely to increase should interest rates increase more broadly.
Okay, awesome. So it's obviously exciting to be the IPO, but we need to talk about who got left behind. There's a lot of questions around Woolworths. So sort of go through a couple of these. Lisa, and just so you're aware, Johannes, Lisa has 3 alpacas. She tunes in a lot, and a couple other people have asked, what is the impact on Woolies? So, and we've had a couple different flavors, so I'll throw them all into this single question. So yeah, what's the impact on Woolies? Does Woolies retain any ownership stake? Is there going to be a situation where Woolies shareholders who got Endeavour will have to sell it because of ESG? And then finally, to make this really, really confusing, apparently, there's still a relationship where Endeavour does pay Woolies a certain amount of money for logistics. Yeah, let's just talk about sort of how that relationship's being severed and what the different impacts are going to be.
Yeah, so just in the interest of time, I'll keep it fairly short. But first off, Woolworths is retaining an interest of around 15% in Endeavour. So that's similar to what we saw in the Coles demerger from Wesfarmers, for those who can remember, around 3 years ago. And then subsequently, Wesfarmers has been selling down that stake. So perhaps Woolworths could do something similar here. But for now, Woolworths retains a 15% shareholding in Endeavour Group, and hence gets those dividends paid out to itself. Now, the second part was, what does it mean for Woolworths as a group? Well, Woolworths is now less diversified in terms of earning streams, and the remaining business also has a skinnier margin. So when we're talking about operating margins earlier, Mark also touched on it, the operating margins in the food business are actually less than they are for Endeavour Group. So in liquor and especially on the hotels business, margins are much better, which means any variation to that margins has more outside effect now. Also, Woolworths is faced with much stiffer competition in food. So I mentioned Aldi earlier, but also Coles is heavily investing at the moment, and also becoming a real force in online food retailing as of 2023, when they start their partnership with Ocado. One part of the question was also, will there be ties between Endeavour Group and Woolworths? Just ignoring that share ownership from Woolworths. For now, yes, there will be a partnership, and there's an ongoing partnership between Woolworths and Endeavour, particularly on the supply chain side. So they'll continue to share warehouses, for instance, where Endeavour will pay Woolworths an arm's length fee. Obviously, they're separate entities now. There's also other areas where they will be partnering. One of it is the everyday rewards card, which is probably important to some of us, is that will be accepted at BWS going forward as well, and those points can be used and earned. And as I said, so there's going to be areas of partnership between Endeavour and Woolworths. Endeavour will pay Woolworths for that, but the structure, the cost structure, pre versus post demerger hasn't changed materially. So Endeavour hasn't become less profitable through this demerger versus how it was within Woolworths. So they weren't burdened, I would say, with oversized costs within that partnership. So we would say it's a fair partnership. And Woolworths also has an interest in maintaining and keeping that partnership. Also on the rent side, and obviously a lot of us are aware that where there's a Woolworths supermarket, there will be BWS attached, and that BWS store will benefit from fairly competitive rent or lease rates that Woolworths pays their landlords. That partnership will also continue. And as I say, it's beneficial for both, because having a liquor store there will also drive foot traffic into Woolworths supermarkets and vice versa. And on the supply chain partnership, just imagine a big warehouse, let's say a 10th or 20% of the turnover in that warehouse goes through liquor versus food. If Endeavour were to leave that partnership, Woolworths would be left with quite a bit of spare room and would be underutilizing its warehouses. So Woolworths does have an interest in keeping Endeavour within its supply chain, just to sweat its assets, if you like, just to make their operations as efficient as they can, especially in the light of this big spending spree we're seeing from Coles on the supermarket side.
Okay, awesome. So we are at 2:00, or a minute before. So we will call it now. I know there's a couple other questions. If you do have questions, send them to me, mark.lamonica1@morningstar.com. I can find answers for you. So big thank you to Gareth and Johannes for joining us today. Really, really appreciate it. I thought it was interesting. So hopefully you guys did too. And then we'll be back on Thursday, same time. We'll talk about how to value a share. Really, really important that nobody asks me the balance sheet treatments of operating leases. So do not do that. Direct those questions to Johannes. But anyway, hopefully that will be good. We'll play with some spreadsheets, which is what Gareth and Johannes do all day. It's nice to remove them from their Microsoft Excel to put them on camera. So thank you guys for joining. And thank you, Gareth and Johannes. I will hopefully see you soon, but you never know.
Thanks everyone for dialing in.
Thanks guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.